If it's Friday, it is the Consumer Advice Series. Welcome. This is the About Mansfield podcast page, and we appreciate you being here today. Earlier today, we talked about migraines. Later today, we're going to talk about your taxes. Right now, in the studio, love talking with Phillip Washington Jr. about wealth, building wealth, and really anything having to do with money. So let's get right into it. Welcome, Phillip Washington Jr.
How's it going? Back.
He is back, and the funny thing is two of the episodes that we do here on the podcast are done by Zoom, and Phillip is actually right here in the studio. He's actually over my left shoulder. I have to look at the computer and be able to do the live stream. So he's behind behind my back, but it works because I can see him. And so Phillip, let's get into let's talk money.
Let's talk money.
Let's talk money. I have a portfolio, but I want to diversify my portfolio a little more. I want to start adding real estate to my portfolio, but I don't want to use my own money because my own money is already growing. My 401k, my IRA, my investments are growing. How can I get into the real estate game without using my own money?
Yeah, and this is a good question. It's a question that came up that I sent your way from a couple of clients, and it's a question that me and my wife had ourselves, especially because right now, like we talked about, wanting to start investing in some rental properties, but with the market being down this much, I'm like, man, it's hard for me to justify putting excess cash into an account specifically to buy real estate, saving up cash to buy real estate, because everything's so on sale right now. And the returns on what I'm looking at in my portfolio, the expected returns, are significantly higher than what I believe we can get in rental properties, however we decide to do it. So I had to put my brainstorming hat on. So I talked to a couple of lenders I know. I understand finance a bit, and the solution ended up being you are able to borrow money against your portfolio, so against your investment portfolio, and different lenders have different qualifications or different amounts. So I'm just going to give you an example of one specific lender I discussed with a mortgage broker, a lender, and it was something to the effect of, if you have let's say you have a $500,000 portfolio and you want to borrow a couple $100,000 to invest in some properties, the math you look at is, hey, if I take $200,000 out of my portfolio, and my expectation is that money over the next 10 years will make whatever, 10%, 15% a year, you may say, well, man, is this investment opportunity with a high degree of certainty going to at least earn me that or more, right? And if you can't answer the question, I love the idea of, if it ain't broke, don't fix it.
Right.
So your alternative is you pledge the portfolio as collateral, you borrowed $200,000, from the lender, and a lot of lenders will give you real favorable rates, right? I mean, one of the numbers threw out in the conversation, and this was just an estimate number, so don't hold to it, but it was somewhere in the 3, 4, 5% range, right? The point is, it's very likely going to be less than what I expect the portfolio to earn, and so you take the lender's $200,000, you invest it in the real estate you want to invest it in, and you still earn money on your money, and then the lender's money allows you to buy the property, and then you make what you make on that. And it essentially, if things work out right and you get a good rate, you're essentially like, you're using none of your money to buy the property, and that's whether it's you're buying it all cash, or that's just the down payment and you're financing the rest. So that's how you do it. You leverage your balance sheet by finding lenders who will lend you money against your portfolio to invest in the deal, and that's a beautiful thing.
And time is really of the essence right now, because if I heard on national news a day or two ago that the feds are going to keep the interest rates low, but they may be going up as soon as March. Did you hear that?
Yeah, and that's a nuanced question. So,
Okay.
and I can answer that question. So, there's the big picture, how Mother Nature works, how the economy works, and then there's the short-term manipulation of truth by central bankers to accomplish a certain goal and mission. Meaning, the reason why we're seeing a downturn right now in the market is because interest rates or bond markets in the Eurodollar market, right? Those are where sophisticated traders trade. So one of the secrets of investing is the Stanley Druckenmillers, the Ray Dalio, the Paul T. Jones, the best macro investment traders of our time that manage billions of dollars, and banks and other people. They look at the bond market to give them information on what's going on in the economy, because the bond market is not traded by AMC stock traders, right? These are the largest stock.
Right.
So the stock market can be dumb in the short term, right? It trades on emotions and theories and stuff like that. The bond market doesn't trade like that, And so what happened was the bond market has been trending, below normal 10-year interest rates since '08, right? Which what that signals is the global economy is slowing down. And so if you want to go back in time and you say, okay, what's a normal 10-year interest rate? It's 5 or 6%, right? Right now we're sub 2. We've been sub 2 for a long time. So what that's telling you is the people who own bonds, banks, governments, pension plans, insurance companies, sophisticated investors, they're looking at everything and they're saying, yeah, global growth is slow because there's too much debt in the system. And just like a person that has too much debt, they can't grow their balance sheet fast anymore, right? And so you have that over here. And then you have the Fed chair who's seeing prices go crazy, people speculating on everything, right? And that could end up bad too over the long term. And so they say, hey, we're going to do 8 rate hikes over the next 2 years, right?
Right.
Which they do rate hike in 0.25% increments. So you do the math, you go, well, man, over 2 years, that puts rates at 2%, 2 years from now, but the rate's not even at 2%. So the market says the spread between the short-term rate, whenever they say rate hikes, they're talking about the short-term rate, right? The 3-month rate. So they said, well, man, if the short-term rate is higher than the long-term rate, or if the gap narrows, that sucks money out of the system. Think of it like a river, right? If a river is wider, it's more water in there. If it's tighter, less water in there, right? More water, good for an economy. Less water, bad. And so when they said that, the market said, listen, the Fed can't do it because long-term rates didn't go up. So the market's saying, we don't believe you, or 10-year, meaning when the Fed says they're going to do that, he's signaling the economy's getting better. 10-year rates didn't gap up the way it needed to gap up. So the market's like, we don't believe you. But we also know that if you do this craziness, it's going to bring asset prices down for a period of time until you come to your senses, right? But we don't know if it's going to be in January, March, February. So we're going to de-risk, which is what the Fed wanted. The Fed wanted people to stop speculating and bring down speculation, which they did effectively, right? So you listen to what they say, but you understand the big picture of what's going on. So
Sure.
So they may or may not do it in March. It just depends on, is there speculation, is there not? Has economic circumstances got worse, right? Has this drop gotten too far? Because, by the way, if the drop gets too far, everything blows up. The whole system blows up,
Right.
and they're not going to allow that to happen. So I know that's a long way to answer the question, but they may or may not. It just depends on what's happening on the day of
It
the
depends.
decision. Yeah.
And I hear a lot of that on your podcast. It depends.
Yeah.
And speaking of your podcast, you are you talk a lot about cryptocurrency, and let's talk about now international news that I heard and also saw on the national news that Russia is looking into mining Bitcoin. First of all, what does that mean, and why would Russia want to get into the mining Bitcoin business?
Yeah. So the short version is Bitcoin is believed by many to be the future of the future currency for doing business around the world. So what gold used to be, like Google gold standard, gold used to be the international peace currency, right? that was interchangeable between countries and places that didn't trust each other because you couldn't manipulate gold. Bitcoin is believed to be the digital version of that, plus everything else that it's meant to be, which is a whole conversation. And so it's no coincidence that as the U.S. is ramping up security and puffing their you got the I call it, you got the two dudes in the schoolyard standing each other ready to fight, but nobody really wants to fight.
That's right.
You got that going on. And so Russia's like, well, man, the whole world is dependent on the dollar-based system, right? Russia needs a dollar to sell oil because oil is priced in dollars, and people trade in the reserve currency for what they need. And Russia has a whole lot of energy. And so Russia's like, well, wait a minute. In order to create Bitcoin, we need energy. We saw what El Salvador did with creating Bitcoin mining with their volcanoes, natural resources. Russia can create a ridiculous Bitcoin mining operation with all the natural gas they have and create lots of Bitcoin, because if that becomes the new world reserve currency, it would make sense for Russia to have some of that from a diversification standpoint. And it pulls the power out of the U.S. hand to control, right, their economics, right? And, so I'm an American. I want America to win, right? So I'm not, but I'm also like a human, and I want more global peace, right? So
that's right.
So I try to think of everything in the context of what are the incentives, and so it's in Russia's best interest to not allow the U.S. to exert power over it from an economic standpoint through the dollar-based system. So that's why Bitcoin mining is something that they probably are looking into, because, that's what's going on. Yeah.
Okay. Let's go from international. Let's bring it all the way back. In fact, let's bring it right back to this podcast studio. I own a business. It's growing. As a financial advisor, how much money should I save and how much money should I invest back into my business?
That's a really good question. So
that's why I'm the host.
So the simple version is there are next to no investments that I believe will do better than investing in yourself. And then if you have an income statement and you track it, you could probably see that the money you put into your business, because it's not just money, it's money plus you, right, which is rocket fuel for growth, right? You're going to find very few, and then the risk is lower because you control it, right? You could control your own business better. You can control other businesses, so you can get a really good risk-adjusted return inside of your business versus like any other place you can invest your money. However, you want diversification. Everybody wants diversification. And so what I tend to recommend is give yourself a salary. You want to figure out what it takes for you to live comfortably, right? Do what you want to do depending on what stage you are in your business.
What if I can't afford the salary that I think that I should have?
Yeah, then you and your CPA need to have some realistic conversations, right?
Okay.
But assuming you have a realistic expectation, then tack on maybe an additional 10-15% of what you need for just saving and investing, and then leave everything back into the business, right? So you might have a goal of saying, hey, I'm going to pay myself $100,000 a year, right, until my business is doing, right, 2, 3, 4 million a year, or until my growth rates stop growing at this aggressive level. And so out of my $100,000 a year salary, I'm going to save 10, 15 grand a year out of that. But everything else I make goes back into the business to build and grow the business. And that's how I've seen it done successfully. That's literally, what my family and I are doing. And I think it's the way to build savings, diversify, but also not starve the business of the much needed cash that it needs to be the best you can be at serving your clients and community.
If anybody out there had any questions about diversifying their portfolio, if they own a business, and anybody has any questions about building wealth, how can they get a hold of you?
StonehillWealthManagement.com is the best place. It has all of my podcast feeds. It has information on who we are. It has a spot to book a time. It has contact information to reach out to us. StonehillWealthManagement.com is the best place to go.
Gonna enjoy your weekend?
I absolutely will. Thanks. I hope you do too. Are you?
It's Mardi Gras weekend, isn't it? The season is
it's-
here.
the season is here, and technically, as Steve pointed out, the season is Carnival season because Mardi Gras is Fat Tuesday.
That's right.
You know, yeah, technically.
Enjoy your weekend. We'll see you next week.
You too.
Thanks, Phillip.